We're going to go ahead and get started. Thank you again for joining us. And again, if you're watching this live, it's 8 o'clock Central Time, Wednesday night, January the 17th. And there is a chat feature on your screen that you should be able to ask questions, make comments. You know, if you can't hear me or can't see something, let me know through the chat. Your audio should be disabled, I believe, so I won't be able to hear anything. But you can chat a question or a message if you'd like. And if you're not joining us live, this will be archived for about 30 days. It'll be on our website, MidwestMarketSolutions.com. So if you're joining us through that, thank you for taking your time out of your day to join us. We did not have a monthly webinar in the month of December, as the report really just was not that much of a difference maker, and it really didn't tell us much of anything. Plus, you get the holiday time frame, so there's not a lot of things going on. But we certainly have a lot to talk about with this January quarterly stocks, acreage report, final production figures from the USDA. So we've got all kinds of things to talk and discuss here. So hope that you have a good understanding when we get finished talking about things, and that things go well here and that we're able to assist you. Since our last meeting, we have a new branch office that makes 10 offices, 8 different states, and so we want to encourage you, if you're in the Illinois area, Merle Crowley is our new branch office there, and so we now cover states of Missouri, 2 in Iowa, Illinois, 2 in Minnesota, North, South Dakota, Nebraska, and Montana as well. So let's get started here and talk about this report and kind of some marketing strategies as we go forward, and just a little bit about our company here. If you would like a copy, this is a PDF file that I'm working through here, and if you'd like a copy of it, I can certainly email you one as well. So before we get started or get too in depth in here, I want to mention that there is a risk of loss and trading futures, of course. We have a disclaimer at the back of this, but we can talk about this just a second, just for compliance purposes, that we believe what we are telling you is our best faith advice at this time, and we can't guarantee that any of these strategies we talk about will work in the future, and of course past history is not indicative of any future results. So what we have is top row in here, we're looking at the supply and demand numbers from the USDA. Corn stocks a little bit above trade estimates, 2.477 billion bushels. That was slightly above the trade guess. We'll talk more about it here in a second. It is above last year's 2.437 and above the last month as well. 2.437 was last month. That was stocks in December, and above last year by a large amount. Soybean number came in at 470 million bushels. That is another very large amount here, and little bit below the trade guess, in line with big range of estimates. Can't hardly go by that, but we did increase it above what the trade had expected in here. So more than last month, well more than last year, and wheat's the only market that was well below year ago levels, and that is I think an encouraging sign for wheat traders out there, that we did see a drawdown from a year ago, and really that's the only encouragement that we have in any of these markets compared to last year. World production figures, this is always key and gets somewhat overlooked by the trade, but you can see here the corn number in the United States, Brazil, 95. The Brazilian corn number above trade expectations, the soybean number above expectations. It is down from last year. Argentina's crop is a little bit bigger than last year in corn, a little bit smaller than a year ago in soybeans, but pretty close to the trade expectations. So, and from month to month changes, USDA didn't lower corn and soybean production very much in Argentina, made up for it with production of soybeans in Brazil. So not much really to change or talk about there. As far as our highlights of our corn report, yields increased by 1.2 bushels per acre. That's a new record for us, and it really suggests that these record yields that we're seeing suggest that genetics are improving much faster than what we believe to be the case not too long ago. So, this spring and into the summer months, we certainly didn't expect that we'd see this type of a yield. And this question that USDA has been asked a lot is how they can be so off on their final yield numbers compared to what the weekly crop progress numbers were suggesting, and it is a major change as we had record yields and 10-year lows in the crop progress numbers every Monday. Corn yields with this increase in production have now advanced to the final in 12 of the last 17 years. So that's a little concerning for the trade here. Production only increased by 26 million bushels, not a major increase, and stocks increased by 40 million as usage was decreased by 15 million. And compared to last year, I think this is one of the keys that we're going to talk about here is stocks are 184 million bushels larger than a year ago, and I think that's a major key as we look forward in here. Couple other things I want to look at is this total usage, that category that we have down here. We have demand at 14.6 billion bushels a year ago, 14.470 this year, as our exports are trailing and look to be a little bit disappointing compared to year ago levels with increased competition on a worldwide basis. But the real problem here is our ending stocks, 2.477 billion bushels, is a big increase when you compare it to last year, 200 million bushels. And a big difference is this total use figure down in here. So something that we'll talk about a little bit more as we look at more information here. Want to point out a couple things on the charts here, and this is certainly a real bearish thing to keep in mind as we've got ending stocks in this area here. This is December 1 stocks. This was another moving piece out of this puzzle here. I'm not sure what computer is doing here, but what we were going to talk about was corn stocks, ending stocks, much larger than we saw just a year ago. So, all right, so we're back here to where we wanted to be. Our quarterly stocks number for this time of year, you can see it's just a huge number. No idea what this is doing. Over 3.8 stocks, much larger than what the trade had been expecting. And you compare it to the last years, going back almost 30 years, you can see we've really grown the stocks from this 2012 and 13 time frame to where we're at now, over 12 billion bushels on hand. And this is the biggest concern I have going into this growing season, is this stocks are increasing. When we get into a situation like this where we see decreasing stocks, that's more of a positive situation like we saw here in 09, 10, and 11, 12. We saw decreasing stocks and the price per bushel increased sharply. Now we're looking at increasing stocks here, and this is a bearish scenario for the market to have to endure. As we look at supply and demand numbers, we go back to that 08, 09 year. Just look at the carryout numbers here, 1.672 billion bushels, and you compare it to where we're at this year. This is RJO's number. They're at 2.552, and we're almost a billion bushels of stocks larger than what we had in this carryout year of 08 and 09. And you can see even going back just 2 or 3 years, we're over 800 million bushels more stocks than what we had. So I know a lot of people want to go back to that $6 and $7 corn mark, but this is a type of stocks that we were looking at during that year. Under a billion bushel, stocks were fairly tight, and since they've been on the increase, we're not anywhere close to that $6 or $7 corn. So it's right now it appears to be a pipe dream. RJO Bryan, our clearing firm for the 18 and 19 marketing year, they're looking at assuming a normal type yield. In fact, even less than what we saw this year, 174.5 is what they're using for their normal yield. They're looking at big production numbers once again, a little bit of increase in exports, but you're still seeing a bigger usage number, but you're still looking at stocks at 2.335, and that's a drawdown from this marketing year. So those are some burdensome levels, and until we get a one back in front of it, I think you just absolutely have to be defensive on marketing as we go into 2018 and start looking ahead into 19 and 20. And that means using a lot of protection on the downside and forward selling as much as possible. So once again, if you have any questions, if I don't explain something thoroughly, please let me know so we can go back through it. The soybeans production actually was lowered slightly this year. It's still the second largest in history. And up until this year, yields have been higher from November into the final report, 8 of the last 8 years. Now it's 8 of the last 9 years we've been higher. So the odds had been in the favor of a higher production number. That kind of caught the trade off guard when it came in lower, and we saw a pretty nice late day short type rally, short covering rally on Friday. Usage is larger than last year, and this is something I want to talk a little bit more about as we go through this. But you look at total usage here. This is a category of total usage, and 4.2 billion bushels is our usage, and that is very similar to what we saw just a year ago, but it is down almost 60 million bushels from last month, as our exports here were lowered by 65 million bushels. Stocks are larger than a year ago, and South American weather is mostly favorable. We do see some dryness noted in parts of Argentina, parts of Brazil, but overall it's mostly favorable weather. We talked about this in corn, how December 1 soybean or corn stocks were on the rise. You can see from 2012 and 13 how much they have risen. At this time frame, we had stocks about 1.9 billion bushels in this time frame, and now we have them over 3.1, almost 3.2 billion bushels of stocks. So this is a bad situation for prices when you have stocks steadily increasing. You have to see more of a trend here like we saw in 02, 03, 04 to get prices to rally. And it certainly has to be a concern for producers as they go into this marketing year. As we look at the balance sheet for soybeans, kind of similar to the corn market, you go back to 2008 and 9 when you had a carryout of 138, 151 million bushels. Now you're looking at a carryout, RGO says, over 5.17, and even would see an increase given next year's numbers here, as they're looking at 588 million bushels of this carryout here as a possibility for 2018 and 2019. So could see even more bearish highlights in here as we look at, if you look at projected numbers, 588 million bushels. Our average yield is similar to a year ago. It's just a problem that we're producing so much crop now that our demand has not kept up within our exports that have started to slow with outstanding competition out of Argentina and Brazil mostly. You can see our export forecasts in the last 10 years have come up quite a bit, 1.5 billion bushels in 09 and 10, for example, versus 2.2 billion bushels of exports. So we are exporting more. Just problem is we're not keeping up. Our usage is not keeping up with our increases in production, and so this is a real concern as we go into this year, that we will continue to do that. As we look at wheat market here, our highlights show a decrease in exports, and go down into this line in here. Our export forecast 975 million bushels compared to a year ago. We were looking at 1,055, and even over the last 2 weeks, our ending stocks here are up 54 million bushels just in the last 2 months alone. So this is a concern as our demand is starting to slow down for wheat. And this is the one market where we've actually seen ending stocks come down compared to last year. If we look at this category down here, ending stocks last year at this time 1.181 billion bushels, still burdensome, but certainly not as much as what they were a year ago. And so we have production losses this year in Argentina and Australia. That's offset by increases in Russia and Canada. And Russian exports are up 25% to last year. Over the last 3 months, Egypt's bought wheat out of nowhere else except Russia, as they have taken full control of the world's export markets to the world's #1 exporter, and that is Russia. As you look at wheat stocks, we have a little bit different pattern. You can see here in this time frame, we've had an increase in wheat stocks during this time frame, 14 to 17. But this last year, we started to trim our stocks a little bit, and this wheat market has been one where it's a little bit quicker to respond to prices. And we saw this here in this time frame where a couple of years we saw increase and then a steady decrease. And we were seeing a couple year increase, and now I think we're in a pattern where we're going to see a decrease in stocks. The question will be how quickly it decreases, and can we get back into this level here where we see stocks be trimmed down. We can actually see an increase in prices. We're doing our job as far as planted acres. You can see back here in the 80s where we used to plant 64 to 66 million acres of U.S. winter wheat. We've trimmed it down into the low 30s, 31 million acres, so less than half of what we did 30 years ago. The U.S. producer has responded to increased world competition by planting less winter wheat than what we had in the past. More production increases in not only Brazil but also Russia. But in the United States, we have not seen that type of pullback in production in corn and soybeans. In fact, we've been ramping up production as some of these acres shifted out of wheat into corn and soybean production. We'll talk a little bit about marketing strategies, and we're getting into kind of the tail end of our webinar tonight. We're getting into our meeting season, and so I know there's a lot of our offices, some of our branch offices are having meetings. I will be doing a meeting in February in Cherokee, Iowa, and I'd like to keep you up to date on those. So, if you have any questions, contact our offices. I know they'd love to help you out as far as marketing strategies. I want to talk about previously what we had recommended going into the fall. This was a big one, I felt. Do not pay for commercial storage. And the reason was just financial. You cannot make it pay this year with the large premiums that it was going to cost to put the crop in a commercial storage facility. A lot of expense in doing that, and the prices would not appreciate enough to make that pay. We had also said if you do make sales, we had some spread strategies for corn and soybean producers, and that was to buy July 380 corn calls and sell the March 370 calls. And so as I look at the markets here today, these 370 calls are going to expire worthless. They expire next month in February, and so we'll have another webinar and we'll talk more about it, but it looks like these are on track to expire worthless, which is exactly what we wanted. This is exactly the right strategy, because you'll be left with July 380 corn calls, and the cost would be a 10-cent difference. And so you have really no downside risk on this, and once these calls go off, you're going to be long July 380 corn calls for a net cost of 10 cents. Those are going to be out of the money by about a dime, and only cost you 10 cents. So it was a good strategy. There's not any premium to put this same strategy on right now. I think you just look at buying the straight calls if you wanted to do something like that. As far as bean producers, we said off of the combine by the July 1040 calls and sell the March 1040 calls. And right now these 1040 Marches would expire worthless. So they'll expire worthless, so they should over the next 30 days. That will leave you with the July 1040 bean calls. Net cost is 20 cents. And they are out of the money a little ways, as July beans are trading right around $9.90. but you do have some upside potential if we do go higher. We did recommend, if you were storing wheat, to sell calls against that stored wheat. There was a pretty good premium in here, and selling the Kansas City wheat 490 calls for 15 cents. Um, they will expire in April, so we've got a little bit more time on those. But May wheat's trading at 440, so we're on track to keep that premium and maintain the storage of the wheat. These March Minneapolis 670 calls. March Minneapolis is at 612, so another month or so we'll collect all of this remaining premium and still be long the product. And the best time for a wheat rally is going to occur in the spring time frame when we break dormancy. So we don't want to give up on owning the crop and making cash sales, but we're going to collect some premium here in corn, soybean, and wheat with these short calls, and then still have some upside potential remaining. Now, let's talk about some new recommendations or things we can look at going forward in here. Still like to sell rallies in corn and soybeans, selling the carry. And what that means is you look out into some of these deferred contracts. You look at the corn market right now, 352 is the March price. July is at 368, so there's 16 cents a carry. That's not as much premium as the December to the July, but it is still a decent amount of premium. I still like selling the July, as there is a little bit of carry out there. Just as a reminder here, beans lost over $1 last year from January through April. And so, this is the time of year where we can either put in some premium or lose some premium because of South American weather. If you're still storing some inventory, especially if you're paying commercial storage at the elevator, our recommendation would be to sell that immediately and turn it into some call options here. I put some prices on July. This ATM means at the money. Corn calls 14 cents, bean calls are 31 cents, and if you have $1 downside risk last year, I think you certainly have that much or more. And if you want to maintain or be bullish going into the spring and summer, these call options are a way to go. Now, looking at selling some old crop price. July corn has selling resistance at 370, which is not too far away from where we're at, and 384 as resistance points. July beans 1005 and 1015. Again, these prices have come up off of their lows that were made recently, and an extension of their rallies would get you into those selling points. There should be, as we noted, a lot of supply to come at the market. That will cap rallies unless we get some major weather problems out of South America. And I remember just a few years ago, I think it was 2015, where everyone had kind of given up on the soybean market, and then late February and early March, it started to break out to the upside because of dry weather in South America, and we saw $3 rallies. So if you do make sales and you want to maintain bullish bias, certainly this is the way to go with some call options that'll give you upside potential going all the way into July. As far as new crop sales in here, want to make those sales on new crop corn starting between 392 and 399, and in soybeans between 1002 and 1010. And I indicate to do small increments. I think you do have to be very defensive this year, but it certainly warrants to start making sales very small increments and kind of get things off and rolling and get your feet wet. As we go into the early spring, if we can hit these prices, a 5 or a 10% sale will help you get marketing and get the ball rolling, so to speak, as far as marketing. Now, you can choose to sell in 20, 30, even 50% increments, but the guys who've done the best job of selling have actually sold in very small increments and made a good average for their year. In fact, some of the best sales last year were guys who sold maybe a little bit every week or every 2 weeks, sold a little bit, and they ended up having a pretty decent average by the end of the year. What I would also recommend is to buy at the money puts for around 20 cents on corn. So if we get up into this area, or we get to $4 in December corn, a put for corn right around the $4 mark should be worth about 20 cents. And that's an area that you would want to protect going into the fall of 2018. Same thing in soybeans. We get up into this 10.02, 10.10 area. Put options 40 to 45 cents are going to give you some downside protection, and you can roll those up as warranted if we do move to new highs in corn and soybeans, maybe every 20 cents, every 40 cents in soybeans. Continue to roll those up and give yourself a better price floor, better price protection. So that is how you should be looking at marketing. Be defensive and be aggressive as far as marketing until weather proves you wrong. So there may be some marketing opportunities. Usually there is every year, but we just have to be quick and take advantage of those. So thank you for your attention and participation in the meeting. If you have any questions or we can help you out in the future, please contact us. You can go through our website, MidwestMarketSolutions.com. And this has been Brian Hoops for our webinar. Have a great night, everybody, and thanks for attending. We hope to talk to you soon.